Jesus' mighty name we have prayed. Amen. Amen. So let's get going. Joe, I thank you. Henry, I thank you. Lisa, I thank you. Eva, I thank you. Jeff, I thank all of you on the platform. Let's get going. Remember today there's something special. And again, I am on 3 different platforms. I'm on Facebook, I'm on Instagram, I'm on YouTube, I'm on Zoom. So if you see me turning from left from right to left, I'm just trying to engage with the entire team. And remember, today's a Q&A session. Ask your questions. Bring people in here. We have the opportunity to get a free session for tax planning, for which is worth over $250. Just bring people in and let me know that you got people to join. I need 5 people each. If you join, you share on your platforms, and 5 people join, you qualify for that free tax planning session. And I have my assistant, I have my team here. All they are doing is just collecting anybody who meets that quota. So we are going to do Q&A. We already have some questions that came in. And Lisa, I don't have the questions with me. You certainly do. So for any question that comes in, if you can take a minute to read it to me before we answer it. Does that work? Are you okay? So you will start. There are some questions that already came in. If you could start with those questions, then we'll get started and we get going. So my first question, the first question I saw coming in. So today we are in that tax planning season. Remember, guys, I told you that there are basically 2 tax seasons. I mean, there could be more, but from my perspective, there are 2 key tax seasons. There's one that is called a tax filing season. When the tax filing season starts, it starts in January. On January 1st of the following year, it's supposed to start. Generally, the IRS will spend a few days just trying to get everything up so that people can start e-filings come the 15th or something like that. But tax filing season starts from January right down to April 15th. It could be extended for those of you who have extensions. So you have a tax filing season that is extended. Those of you, and then there is the most important, which is even far more important than the tax filing season. It's what we call the tax planning season. And the tax planning season for some people is the whole year. It starts generally as soon as you finish filing. So when we are going towards the end of the year, the last quarter of the year is the most important part of your tax planning. And what you do is that you're reaching out to tax planners, not tax preparers. You're reaching out to people who understand the tax laws, people who are able to strategize your taxes to make you optimize your tax position. And those people, you are either reaching to a tax strategist or to a tax planner. And their role is to go through your financials, go through your situation, go through your intent, and be able to tell you what you need to do in order to minimize your tax position, in order to optimize your tax position. Because some people have other objectives from others. You want to make sure you optimize your tax position. And for you to do that, you have to be doing that through the tax planning season. We are at the heart of the tax planning season. And for all of you out there who are either making money, making little money, making a lot of money, or you own businesses, you're investors, and I know there are quite a few of you on the platform. For those of you out there, this is the time to talk to a tax planner. So our role today, and we've started that since a couple of weeks ago, it's all about preparing you guys, telling you those tips that you need to get, those things you need to do to make sure that your tax season, that when you get to the tax period, which is January, when you get to January, you're already ready. You know what your tax position is. You know what you're owing. You know what you're getting back and things like that. You don't want to be surprised when you do your taxes. Only, I don't want to call them blockheaded people. That is why we do this free session, so people understand how to plan their taxes. I see a lot of people coming in on Zoom. Guys, you're welcome, you're welcome, you're welcome. Keep sharing, Keep sharing. We need more people on the platform. Keep sharing. So today I'm going to talk a lot about tax planning, but I'm also going to follow your questions. I'm going to do your Q&A. The first question someone asked me was, what is the difference between effective tax rate and marginal tax rate? I thought that was an excellent question. And the reason that's an excellent question, because I have seen a few people come. I've seen people tell me they don't want to pay tax. They don't want to basically make money no more, because when they make the money, they are going to enter that tax bracket, that higher tax bracket, and be paying more. So the first thing you want to know is, what is tax? For you to understand the concept of marginal tax rate, you have to understand that, for example, in the US and many other countries, including Cameroon and many other countries, we have something that is called a progressive tax rate. And that progressive tax rate means everybody gets to pay a certain amount of tax for how much, whatever they earn. So if you are making anything less than, let's say you're single. I'm taking the example of the United States. You are single and then you made $10,000 a year. If you make $10,000, I think the number is around this $9,950 or something like that. And that is for 2021. If you made the first $10,000 that you make, you're going to be taxed at 10%. The next $30,000 up to $40,000 that you make, you're going to pay $12,000 on it. You are going to pay 12% of that money in taxes. Remember, this is about your taxable income, not your gross income, because there are certain elements that you have to reduce from your gross income to get to your taxable income. So if you're making $20,000, that is not an amount I'm talking about, because after that $20,000, there's something called standard deduction, itemized deduction, that are going to be reduced from that number to get to your effective tax number, to get to your taxable income. Once your taxable income is at these levels, then you pay certain rates based on how much they are, any additional tax. So if you made, say, $50,000, the first $10,000 of that money will be taxed at 10%. The next $40,000, the next $30,000, so $10,000 have already been taxed. The next $40,000 will be taxed, $30,000 will be taxed at 12%. Then any additional money over that will be taxed at 22%. Then a guy who makes $1 million, it means that you have the 10%, you have the 12%, the 22%, the 24%, the 32%, 35%, and 37% tax bracket. And most of your money will go into the 37% tax bracket, because anything over and above $157,000, right, you're going to be taxed at 37%. So what is marginal tax rate? Marginal tax rate is that tax rate that you get for any additional dollar. Every time you add a dollar, if you are at 10% tax bracket and then you are about to enter the 12% tax bracket, it means that any additional dollar will be taxed at the next tax bracket at 12% tax bracket. So your marginal tax rate is actually that 12%. It is your top tax rate. That is what you call marginal. That tax rate for any additional dollar. The second, the effective tax rate, is the average tax rate on which you are. So you basically take your tax, you divide it by your taxable income. Your tax paid all over your divided by your taxable income will give you a rate, which is an average rate. That's what you call effective tax rate. I had some questions about how do I reduce my taxes. That's a very big question. I'm going to try just tell you a few things that you need to do to reduce your taxes. And remember, guys, I've just said, keep sharing. Share so that we have as many people, because the last 5 minutes we're just going to be giving out whoever has won for the $250 tax-free tax session. Okay, so how do I reduce my tax burden? That's a great question, but it's a big question. It all depends. There are so many things you can do to reduce your tax burden. So many. Some of them is, I'm just going to go through a few of them, but the first thing you want to do to reduce your tax burden is to make sure you have proper accounting system. I can't emphasize this enough. I do a lot of tax resolution. My job is one of my biggest things, one of the big things we do in our firm is tax resolution. People are getting hammered by the IRS. And remember, the IRS just got allocated $80 billion to hire more people to do what? To do compliance. And compliance means you're going to be hammered. The IRS needs to raise $326 billion to fund what they call the tax, Inflation Reduction Act that was passed a few months ago. So there is going to be trouble coming ahead for all of us who are business people. We just need to do one thing. Let's make sure our records are properly kept. That's the best way to save yourself from any tax trouble. Number two, we just talked about tax brackets. You can manage your tax brackets in many, many ways. We can talk about that the whole time. You can manage your tax bracket by increasing. I told you there are tax brackets. You want to go, if you are already getting into that 37% tax bracket, you can maybe, for example, manage your accounts receivable. You can do your working capital management. Is a way that you can basically use to regulate where you are going with your taxes. And that is something that you need to speak with someone who is a professional. He helps you regulate, make sure, do I need to pay now? Don't I need to pay now? What do I do towards the end of the year to make sure my taxes end the way I want them to be? And for you to do that, you need to know where you stand. And for you to know where you stand, you have to, first of all, know about your numbers. So knowing your numbers starts with bookkeeping. Secondly, you can manage your tax brackets. There's a lot of things. That's by itself. When we talk of tax planning, it's first of all managing your tax brackets. Another thing you do is you can defer your incomes. You can decide not to pay taxes now on certain parts of your income, and doing that you do retirement benefits. You put money into your retirement fund because these are incentives that are being given to you by this government, by the states, to make sure that your retirement is properly managed. And for when you do that, you avoid certain taxes, you defer certain taxes. So tax deferral is a big place where you play with money. You have Roth IRAs, you have 401ks in different forms, you have traditional, you have all those things. You have to be able to manage those things properly in order to avoid certain taxes, in order to defer certain taxes, in order to manage certain taxes. Reinvesting in businesses. You can also reinvest in other. Yes, when you make money in the business, you can reinvest the money. Remember, the whole concept of tax in America is that you're being taxed on income. You're not being taxed on money that's not income. If there is no money, if you don't make income, you don't pay taxes. So if you reinvest some of that money, there are certain tax benefits that you get by reinvesting that money. First of all, and then building your business is also something that the IRS is. Remember, I told you in one of the sessions that the IRS is not a sanctioning body. It's not just a revenue collection agency. It is a government policy tool. It's a government policy tool. When the government wants to run a policy, when they want to make certain things happen, they use the IRS as the fiscal, as the fiduciary. That's the guy who really manages some of those things. They incentivize those areas where they are weak and they need your help on, and then they tax those areas that they don't need as much. So tax reinvesting, taking advantage of a certain tax incentives that are within the tax structure is very important. Using debt financing, another big one. Managing capital when you dispose of assets. Managing your capital gains. When you have capital gains, what are capital gains? These are monies. These are gains that you make as a result of disposing of assets, disposing of anything that's a capital item. When you dispose of your property, you dispose of your of your stocks in the market, anything that you have that is of tangible value, when you dispose of it, you create a capital gain. It can be short term, it can be long term. You need to manage that. And then real estate investing, there's a huge, we talk a lot about real estate because I believe that that is the big place where you can do a lot of wealth management. You can manage your wealth through real estate. A lot of things that we're talking about, making the best of Section 121. Section 121, you're selling your home. You want to sell your home and take advantage of it. You can even sell your home to you can structure another structure, which is a reflection of yourself, and basically sell your home to yourself through another vehicle. And then you use that vehicle to make money. First of all, when you do that, you're going to get something that you're taking advantage of Section 121, and then now you can use that property as a rental property. So you just take advantage of Section 121 and something that they call Section 1031 exchanges. When you are in business and you are buying property for rental and you're doing that, you can do 1031 exchanging. Cost segregation, that's a big one, especially when you are a real estate professional. When you are in business, you can do cost segregation, getting the best tax structure for your company. I can't emphasize that enough. I've talked about structuring your company so many times, and getting the best tax structure will help you avoid taxes. Proper bookkeeping, we've talked about that. Hiring the services of a tax planner. Many people think that having a tax planning, again, let me tell you something. If somebody is preparing your tax, you're preparing your taxes, he's not your tax planner. Somebody is doing your bookkeeping, he's not your tax, because tax planning is by itself is another function. It is a very, very big function. And if you want to take advantage of these things and you are out there, you're making money, you need the services of a tax planner, not the tax preparer, not the bookkeeper. These are wonderful people, but a tax planner will help you structure and avoid your taxes. Hiring it, doing it early, taking care, and even hiring your children, taking advantage of family members and things like that. Lisa, anything on? More questions, please. Any other question?
Time to write the questions.
So please write your questions, send your questions in. We have a lot. Let me see. There's some questions that have been sent in. Let me see. We have, yeah, I see some questions in. If you look on that page, the page that you sent me, there were some questions on there because some questions are coming on there. Yes, another question. And if you have any question, you want to talk to me, you want to connect, try to connect, we can connect. We have a few more minutes. We have about 10 more minutes. We want to talk about these things. There's a lot of things we can talk about. There's a lot of things we want to make, we want to talk about today. So when I talk about tax planning is really the key. We talk about hiring the services of your family members. There's a video that we made on how you can make your children work for you and how you can build generational wealth for those children by that money that you're paying them. How you can do that, and then that generational wealth will be tax-free. Imagine you paying your children today $6,000 a year, or $10,000 a year, or $12,000. Remember, the standard deduction is a number. Imagine you're paying them standard deduction, and there are about 4 of them. You pay them today, you invest it in some vehicles that I talked about in some of my videos. And when this child gets to 59, that money is over millions and millions of dollars, and they have access to that money. What? Tax-free. They have access to that money tax-free. That is how people are building wealth. I talk to a lot of people. Imagine, our community, we don't know how to do it. That is what these white boys, they are doing that. They've been doing that consistently for so many years. And then we sit there, we think that they're doing magic. They're not doing anything magic. They're just taking the services of the people who can do it and help them structure this. And before these children get to certain ages, they have millions of dollars in the bank. They have millions and millions of dollars in the bank. So please, let's learn from these people and be able to do some of these things that they are doing. Another question I'm getting is, what is the difference between standard deduction and itemized deduction? Okay, I talked about standard deduction a few minutes ago. Standard deduction is a number that is given to you. You are basically, it's that amount of money on which you don't pay any tax. So basically, whatever you earn, the government has said that, okay, there's an amount of money that at least you need that to live. We are not going to tax that. and that standard, that amount is determined by the legislator. This year, as of following the Tax Cut and Jobs Act, which was the massive tax overhaul that was done in 2017, they moved the standard deduction to 12,200 at the time. Now it's moved with all the inflation and stuff, it's about 12,550 as of last year for single. And then if you're married, that number is twice, which is 25,000. And then if you're head of household, that number is about 18,000 or 18,650 or something like that. Those numbers that I gave you, depending on your filing status, those are numbers that if I made any amount of money, up to that amount of money, I don't pay no taxes. I don't pay no taxes. So standard deduction is that amount that you must deduct from your income, as a basis, and then you're not taxed on it. Now, there are two types of deductions in this particular category. There's something you call standard, which is that given number that they give you based on your tax status. There is that thing that is called itemized deduction. So itemized deduction is the alternative. If you're not using standard deduction, the alternative to using standard deduction is itemized deduction. But itemized deduction, there are certain things that come in: medical bill, mortgage interest deduction. There are things like property taxes. There are certain things that are all the health care. When you have your medical expenses, all those things that come in there. So those things that are added there, if you add all those numbers, those things that are part of the itemized, that you are able to itemize, if you add all of those that accrue to you during the year, and they are more than that number that's given to you that's called standard deduction, if they are more than, then you are allowed to use that itemized deduction. So you can either use standard deduction or itemized deduction. The difference between standard deduction is that you're given that number. Just use it if you don't want to complicate yourself. Or if you have many items of itemized deduction that are giving you a higher deduction, then you use itemized deduction. So you can use either or. And there are many very strict rules around there. So please be careful how you use them.
Check Instagram for questions.
Yeah, also, is the employee retention credit closed? That's a good question. The employee retention credit has been closed for operations that are ongoing now. So if there is any activity after December of 2021, the employee retention credit became closed. You cannot get employee retention credit on activity after the 31st of December 2021. However, for those who have not applied for their employee retention credit for the years, for that period, if you have not applied for your ERC, you are still open. The window is still open for those of you who are. If you think that, oh, maybe I made a mistake, my number was not right, or I need I didn't apply for my ERC, it is still open. You can still apply for your ERC. ERC again, what is it? It is that credit that is given to those who were able to stay in business after the pandemic. So it is based on a simple logic. First of all, it is based on the fact that for those of you who were in business before 2020, when the pandemic hit, you're comparing your activity per quarter for 2019 against 2020. If for any one quarter your activity is down by a certain percentage, then you qualify for employee retention credit, and then you are being given a certain amount of money on your employee retention. That is employee retention credit. Then for those who started their businesses after the pandemic, those guys are called those who there's a name for them. Those are called there's a name for them. So those ones who started their business after the 31st, when the pandemic hit, you still get access to the last 2 quarters of 2021. of employee retention credit. You automatically qualify by virtue of the fact that you invested when everybody was running away from investment. That is those are the things. So to answer your question, it is still available only for the period that they were open for. You cannot apply employee retention credit for activity after 2021. I have a question: at what age can you include your children on payroll? That's a great question. So this is something that I had a video on. At what age can you include your children on payroll? There is no age. The labor code doesn't really state an age for you to get your children on payroll. The point is, you have to know the standard. What is the standard from the IRS perspective? The IRS clearly states on the website that it is advantageous for you to use your family to use your family in your business. Now, the age, the only thing that the courts have heard is that there was this case that was heard by the courts that they heard that a child was reasonable enough at the age of 7. So people have been taking that age of 7 and saying that that's the beginning age, but there's no age in the tax code. The second thing, or in the labor code, the second thing is that the tax code talks about they have two standards that you have to consider for anything to be deductible as a business expense. Number one, that expense has to be ordinary. Ordinary meaning that it is a similar, that type of expense will not only accrue to you, but another business of that same nature will also be incurring that type of expense. So it has to be ordinary between businesses of the same nature, and then it has to be necessary for the business. Necessary becomes a little bit gray. Necessary means that you need it for the operations of your business. And I've seen a lot of different cases around there where people have brought in private jets and said, yes, it is necessary for my business, and they've won the cases. So ordinary and necessary are those are the standards that are being set for any business deduction. So again, to answer your question, at the age of 7 is what was held, but generally any time that the child is able to provide services. And when you have your child on payroll, be careful. It is not just giving money. It's not a vehicle for you to just transfer money to your kid. There are clear rules around what you need to do to make sure that if you are audited, because that is an area where anything that has to do with related party is a gray area, and the IRS will, with their algorithm, they will likely pick that for an audit. And you want to make sure that you had that child, he had a proper work contract, he had a proper time, he kept proper time, and then not only did they keep proper time, that they did some work and you were able to document the work they did, and you're paying them a reasonable salary, you're paying them a reasonable wage. And at times I tell people, open an account for them, put that money in there, and then I can tell you how to put that money so that you make more money, so that you create generational wealth for that kid tax-free. So I hope I answered that question. Any other questions coming forth, Lisa? So I want to talk about one thing here. So I have, somebody's asking me about tax brackets. He said, what is tax bracket? Tax bracket is, I already talked a little bit about it. I think you came, you might have come after I talked about. So tax bracket is really structuring. You structure it is those levels, in the United States, we have what you call a progressive tax system. The tax system is based on the higher you earn, the more taxes you pay. But you pay taxes differently on different additional income that you make. At the same level of income, everybody is paying the same tax rate. And then as you get additional income over a certain amount, those additional income, which are called marginal income, additional revenue, additional dollars, are being taxed at different rates depending on how much is being added. So when you talk of tax brackets in the United States, as of now, we have 10% tax bracket. We have 12% tax bracket, which is when you make additional income over a certain amount, you pay 12% on that additional money. Then you pay 24%, there is 22% tax bracket, there's 24% tax bracket, there's 27% tax bracket, there's 32% tax bracket, there's 35% tax bracket, and there's 37% tax bracket. So above $157,000 for everybody of taxable income for anybody who is single, you are practically paying any additional money above that will be paying 37% of taxes. And remember, this is not all. The reason we're talking about tax planning is that we are able, as strategists, as tax strategists, as tax planners, we are able to help you structure your money in a way that you can avoid some of these taxes within the confines of the law. As long as you do certain things before the year end, you do certain things before, and those things are all those things that the government is trying to incentivize you to do. Many people don't know what they are. Many people don't know how to do it, and that is what we help people do. So if you have a problem with that, contact us. We're here to serve you. Guys, Lisa, is anybody winning our contest right now?
No, for now.
No, we have no person yet. That's not right.
Ask them if they.
That's not right. Okay, if we cannot get 5, we get people down. We can reduce the number. We have to make somebody win today. Somebody has to win. What question is that? I have a lot of questions coming through for me. Somebody's asking me, what is debt financing? That's a long. We can make 5 different videos on what debt financing is. Debt financing is simply using debt to finance your business. It's simply using debt to finance your to build wealth. It is simply using other people's money to get to where you want to go. So debt could be any type of debt. There's so many different types of debt, but the reality is that when you get a mortgage, you're using debt because you're using bank money. When you have people to come and finance, or maybe you get a loan, or you get credit on your suppliers, you've sold something and you've not paid people, you're using that debt to finance your money. That's why we talk about working capital management, we talk about debt. And I have said this before, I've said that as long as there is debt, there is something called depreciation, there is something called cost segregation in the market out there. There is every opportunity for those of you in the real estate market to avoid paying taxes altogether and to be able to transfer that wealth generational from one generation to the other generation tax-free. And we can talk about that. Yep. So any other question? Hope I answered that question. Somebody's asking me is, can I have a 401k for my business? Absolutely. You can set up a 401k as a business. There are people who we call tax plan. There are people we call financial planners, who are those that set up 401ks. You can set up any type of deferral plan. If you are a solo business, you can set up a solo 401k for yourself within the business, and you get a lot of tax deferrals on that money. I think that you can basically put in up to $100 and something thousand in there, and then you are deferring it for the future. Depending on your age, you're being given certain latitudes to put more money into your deferral, into your retirement money. And there is something as well. I have somebody asking that question about how can I use my Roth IRA, how can I use my retirement money to fund my business? That is an excellent question, and I think it's worth a video on itself. Many people have structured business, have put money in retirement, and that retirement is playing in the stock market, and when the market crashes, their money disappears. When anything happens, their money is disappearing. That is not what the tax legislature intended. The intention of the tax legislature is to make sure that you have that money when you retire. And they have allowed you, there are certain things that are called self-invested. I don't know, my head doesn't work today, but you have self-directed investments, self-directed plans. Generally, when you have money in a 401k, you have money in a Roth, it is not self-directed. You are entrusting it into some company to invest it on your behalf. But there are also self-directed plans where you can basically invest it yourself. it has to be structured in a particular way, and it has to be made in a way that you're not taking money out of it, but you can pay yourself from the operations of the business. So you can basically have helped clients to take money from their 401ks and then structure a business. I've helped clients to take money from their 401k and then invest it into real estate. So basically, there are places where you know that if you put your money, you see somebody, there are places where you know you can put your money and then it's not going to lose value. It's not going to be going through the troubles of the stock exchange market. Then you can put your money there. Again, that is called self-directed retirement benefits. I think we are almost getting to the end of this. We've gone past our time. We've been on it's 35 minutes already. I see a lot of questions still coming in. Somebody's asking me, manage. How do I manage? What do you mean by capital gains? I sold some assets and I'm trying to understand how I can. Okay, so capital gain is when you sell any property, any item of property, be it stocks, be it your home, be it your real estate, being it if you have paintings and you sell them. Whenever you sell any item of property, you generate something it is not an ordinary income. Ordinary income is where you get from a business or you get from work. That is ordinary income. Capital gain is when you sell an item of property. When you sell an item of property at a higher price than the basis in the property, which is the cost that you've incurred in the property to date, then that excess is called the capital gain. Or it could also be a capital loss. So you have a capital gain, which is the benefit that you get from selling a property, or you get a capital loss from selling a property at less than the fair market value of that property, at less than the cost, at less than the investment that you've put in that property. Then you get capital loss. And the tax law is a little bit lenient on capital gains and losses. If you have a capital gain, the way it works is that when you sell your property, on some items of capital gains, they basically just avoid you paying taxes altogether. If you sold your property like your home, you sell it, and then you made a gain of anything, if you're single, anything less than or equal to $250,000 as a single person, you've owned that home for at least 5 years, and then you've lived in it for any 2 out of those 5 years, you sell it, you make a capital gain of more than 250. Capital gain, again, is not the price at which you sell. It is the difference between what you've invested in the home and what you are selling. So if you invested $750,000 in a home and then you sold it for $1 million, then you have $250,000 of capital gain. And that capital gain of $250,000 or less is non-taxable for anyone who is single. If you are married and you're filing separate, it is still 250. If you're married and you're filing joint, that number becomes 250 times 2. So that's an important question. So that is the concept of capital gain. And then if you made a loss on a capital, if you made a capital loss, that loss depends, the way you treat the loss depends on your circumstance. There are so many ways you can treat the loss. Depending on if it's a business and it's an ordinary income and you're involved in it, then you can use that loss against your ordinary income. But there's so many things you can talk about there. Otherwise, you can carry it forward and then you take $3,000 within 1 year. So those are some of the things we can talk about. Someone is asking me, what is passive activity? Passive activity is anything you are not materially involved in. So if you're not materially involved in running in any business, for example, if you own shares in a company that is running by it's running, and then you only own shares, you don't run the business, you don't take decisions, you only attend board meetings and things like that, the decisions are taken by some people, by somebody else, then you have passive activity that is going on there. But when you materially participate, which there are rules, what is materially participate is another question. But when you materially participate in those things, then there's a whole set of rules around. Then you can basically then When you materially participate, then it's no longer a passive activity. So passive activity is something that you've just invested your money and your money is working for you. It's a very, very good thing. It is good in certain circumstances. For tax purposes, that's a good tax. That's something we also use for tax planning as well. Lisa, any more questions? Okay. No questions coming in. Somebody's asking me, how can I contact you? Simple. To contact us is very simple. You can contact us. We have our number on the screen. The link that were sent out. Our numbers are there. If you go to chnadvisors.com, you see our numbers there. You can contact us directly. You can contact our company. The number is right there. It's 832. Lisa, can you just call the number out?
9010166.
What is that?
832-901-0166.
832-901-0166. You call the office, or you can send me an email. You can send an email to either myself or anybody. If you send any email at info@chnadvisors.com, it comes directly to us, or charles@chncpassociates.com, charles@chnadvisors.com, or you send us an email. You go to Instagram, you go to YouTube, all those platforms, they have our contact numbers. You can contact us directly. You can contact me directly. I am available anytime to help you guys. Our aim, remember, our intent is to grow together. We have to grow. We have to win. And we have to use all the knowledge that we have in this country to take advantage of the system, to take advantage of the structure that is being given to us. This is not anything that we're playing, we're taking advantage or playing against it. It's an incentive that's available for us. Let's make use of it. So guys, let me see who is going to be our lucky winner today. So Lisa, you said we didn't have anybody that really won that number. But I'm going to just look out there and see whoever. Lisa, do you have a preference of anybody to? Oh geez. Let me look at any. Okay, I've seen some questions. Anybody who sent, let me see the questions that are out here. For a home-based business, can you file for rental and utilities deduction? Home-based business. It's a home-based business. When you have a home-based business, there are so many things. There are a few things you can do. That question came from a Chris Akibi. Okay, when you have a home-based business, there's what you call you can deduct certain activities related to the home. Every activity you can deduct expenses related to home office in that business. Now, when you talk, can you file for rental and utility deduction? You can deduct every utility when you have a home-based business. There's a office, that's home office. But remember, there are very strict rules around being a home office. It has to be a dedicated space for that business. You cannot just say I have home office, whereas the IRS doesn't know. Oh, I have you. If you have an office that you're using for your home office, and then there is any other thing that's being done in there, you're failing on that rule. It has to be used exclusively for that business, and it has to be used continuously for that business. So if you have a space in your office that is used for that, you can take part of your rents as part of your home office, because you have to allocate your utilities and you allocate some of your rental expenses into your home office, and then you can deduct that from the office income. Because the whole concept is that home, if you were renting somewhere, you'll be paying rent. So part of that home, the rents that you're paying, or if you're paying rent or you're paying mortgage, part of it should go to that home as the part of the home office deduction. Another question is, what was the quiz challenge again? It's at the end, Chris. It's at the end. Thank you. What qualifies you to run for tax-free business? I just said it, Rachel. I said, what qualifies you to run for a tax-free business? Tax-free business is what you call a non-profit. You have to be providing a service that is not for yourself, but it's for the community. If you're providing any service that's for the benefit of the community, that's for your not for personal goal, then based on that premise, You can apply. First of all, you register the business. We had this last week. I think it was a week before. We did something on the 501c3. So when you have a business that is really aimed at satisfying a need in the community and not for personal gain, and these are really generally structured as a basis for when people come on and they have a passion for something for the benefit of humanity, then you can now apply for what you call a tax exemption. You get a tax-free. Generally, you get a 501c3, but there are so many different options of 501c. There's 501c1 right up to 35, I think. But the general one that you find in 35%, in 90% of the cases, is 501c3 for churches, for non-profits, every type of non-profits, and unless you're doing donation, and then even if you're making lobbying and things like that, you have all those non-profits. And when you qualify, you have to constantly continue to do that activity, which is considered a social response, which is considered for the benefit of the public, of the community, of others, not for yourself. Then you can qualify. You have to apply with the IRS. There's a form called 1023. You fill out that form. There's a short form, there's a longer form. You fill out that form, you tell them your intent, you give them your you send them your articles of incorporation, and those articles, which are the bylaws of the company, should be clearly stating the goals, the intent, the purpose of that company, and then you can get a tax-free business. You can run a business tax-free. It's a very lucrative activity. Many people, remember, tax-free doesn't, you're working for the community doesn't mean you don't pay yourself. So the company, you can pay yourself, pay your family members. It's a very lucrative thing. And the big thing about 501c3 is that you can use it as a vehicle for avoiding certain taxes. And then number two, you can also use it to build some sort of passionate thing that you want to build for yourself in the future. Many of our rich people, they create foundations and they use it. Is it okay to file taxes to not file taxes, and what are the implications? It is not okay not to file taxes. It is not okay. There are certain, let me tell you, the only time you cannot file, you will not be allowed, you may not file taxes. If your income is below standard deduction, or for your status, you are not required to file taxes, because you file taxes you may only file taxes if you're claiming a refund, but you file taxes because you're owing the government. And then if you know that for sure, your income, your taxable income is less than your standard deduction, and you don't own a business, you're just by yourself, then you may be allowed not to file taxes. But you need to file taxes for many other things. You need to file taxes because you want to have access to other people's money. You want to be able to buy your home. You want to be able to do certain things. So you want to file taxes. If you don't file taxes, and you were supposed, once you own a business, you have to file taxes. There's no exemption when you own a business from filing taxes. The other question is, what are the implications? If you don't file taxes, the IRS will file it for you. The IRS gets the money because any person you've interacted with, they will send forms to the IRS. I do tax resolution, and one of the big areas I see, when you don't file taxes for 1 year, the second year, the IRS just sends you a notice and says, okay, these are your taxes, because they just They do your calculation based on the income that has been reported to them, and then you get it. You get, first of all, the IRS will help you file the taxes, and they will give you a number that you don't want to see. That's number one, because no deductions will be put in there. They'll just send you a number. Number two, you're going to pay significant penalties because you didn't file. There are penalties for late filing, penalties for non-filing, and then it is one of the biggest creator of a tax audit. You don't want to go there. Hopefully I answered that question. Okay. I think we're running out of our time now. If you have any other questions, you keep sending them. Remember, we have these every week. Every week we're here, we're talking to people on these platforms. I want to thank you guys. I thank the Lord for being with us today, and I hope everybody who was here on here today, your questions were answered, and you were able to gain from this session. Again, I just want to thank you. We are CHN advisors. We help you out. We help educate you on key things that will help you build that wealth.